Applovin Corp, trading under the ticker APP, is currently priced at $587 per share, representing a significant intraday drop of $95.76, a staggering 14.03% decline. This sharp downturn immediately prompts a closer look beyond the surface-level numbers. The immediate narrative might point to a simple market correction after a period of substantial gains, a natural ebb and flow. However, the reality of this dramatic single-day movement is far more complex, pointing towards a significant shift in investor sentiment driven by external pressures that challenge the very foundation of its recent rally. The expectation was that Applovin, a dominant force in the mobile ad tech space, would continue its upward trajectory, fueled by its powerful AI-driven advertising platform. The reality hitting the market today is a stark reminder of the immense regulatory risks that loom over the entire data-driven advertising industry. The catalyst for today's precipitous drop appears to be a Bloomberg News report suggesting that the Securities and Exchange Commission is probing Applovin's data collection activities. This news strikes at the heart of the company's business model, which relies heavily on sophisticated data analysis to optimize mobile ad placements for its clients. While the company has stated that it regularly engages with regulators and that such inquiries are part of its ordinary course of business, the market's reaction has been anything but ordinary. Investors are clearly spooked, and the selling pressure is intense. This isn't the first time the company has faced scrutiny over its data practices. Earlier in the year, short seller reports raised similar concerns, alleging that the company was essentially force-feeding app installations and improperly leveraging data from other platforms. Though the stock recovered from those initial allegations, this renewed regulatory attention from a body as powerful as the SEC introduces a new level of uncertainty. Many investors who have been enjoying the stock's impressive run-up throughout the year are now rushing for the exits, choosing to lock in profits rather than weather a potentially protracted and damaging regulatory battle. This is a classic case of expectation meeting a harsh reality. The expectation of continued, uninhibited growth is now clashing with the reality of potential regulatory headwinds that could fundamentally alter the company's operations. This situation is particularly concerning for those using platforms like Schwab Intelligent Portfolios or engaging in self-investing through services like Fidelity or SoFi Invest, as such a sudden news-driven drop can be difficult to navigate without a deep understanding of the underlying risks. Analyzing the recent trading activity leading up to this event provides further context. In the weeks prior, Applovin stock had been on a tear, buoyed by a wave of analyst upgrades and positive sentiment surrounding the launch of its new AI advertising product, the AXON Ads Manager. Firms like UBS and Piper Sandler had raised their price targets substantially, citing optimism about the new platform's potential to unlock significant new revenue streams outside of its traditional mobile gaming stronghold, particularly in e-commerce. The narrative was one of a company successfully expanding its total addressable market and leveraging its technological prowess to drive the next phase of its growth. Trading volumes were robust, and institutional investors were increasing their positions. This bullish sentiment was reflected in the stock's performance, with shares rallying significantly. The recent drop, therefore, represents a complete reversal of this momentum. The high trading volume accompanying today's decline indicates that this is not just a minor pullback, it is a significant shift in the market's perception of the company's risk profile. Those who trade on platforms like Robinhood or Interactive Brokers, which offer real-time data and fast execution, would have witnessed this dramatic downward spiral unfold throughout the day. To fully grasp the significance of these developments, it's important to understand what Applovin does. At its core, Applovin operates a software-based platform that helps mobile app developers of all sizes market and monetize their apps. It provides a comprehensive suite of tools that automate and optimize the marketing and monetization process, driven by advanced machine learning and predictive algorithms. The company's technology helps developers acquire new users and maximize the revenue they generate from their apps, primarily through in-app advertising. A significant part of its success has been attributed to its AI engine, which can predict with a high degree of accuracy which users are most likely to engage with an ad or make an in-app purchase. This is what makes the SEC probe so concerning. Any restrictions on its ability to collect and use data could severely hamper the effectiveness of its platform. The company's recent financial performance has been stellar, with its second quarter results for 2025 showcasing a remarkable 77% year-over-year revenue surge and a 99% increase in adjusted EBITDA. These figures were largely driven by the strong performance of its AI-driven AXON platform, reinforcing the market's belief in its technological edge. For investors in Fidelity ETFs or Fidelity mutual funds with exposure to the tech sector, Applovin's performance would have been a significant contributor to their returns until this recent downturn. Looking ahead, the future outlook for Applovin is now shrouded in uncertainty. There are several possible scenarios that could play out. In the best-case scenario for the company, the SEC probe concludes with no material findings of wrongdoing, and the market comes to view today's sell-off as an overreaction. In this scenario, the stock could rebound as the focus shifts back to its strong fundamentals and growth prospects, particularly the potential of its AXON Ads Manager to penetrate the e-commerce advertising market. However, the worst-case scenario is one where the SEC investigation uncovers significant issues with the company's data collection practices, leading to hefty fines, an injunction forcing it to change its business model, or both. This would be a devastating blow and would likely lead to a prolonged period of underperformance for the stock. A middle ground scenario could involve a settlement with the SEC that includes some financial penalty and changes to its data policies, which would create a near-term headwind but might ultimately be manageable for the company in the long run. Investors will be keenly awaiting the company's third quarter earnings report, which is expected on November 5th. The consensus EPS forecast is $2.34, a significant increase from the $1.25 reported in the same quarter last year. The management's commentary during the earnings call will be critical. They will undoubtedly be peppered with questions about the SEC probe, and their ability to reassure the market will be a key determinant of the stock's future trajectory. Comment below with your thoughts on whether you believe the SEC probe will have a long-term impact on Applovin's business. For those considering online investment opportunities, this situation highlights the importance of thorough due diligence and risk management. Platforms that offer investment help, such as Schwab Intelligent Portfolios, are designed to mitigate some of this risk through diversification, but concentrated positions in individual stocks like Applovin can still have a significant impact on a portfolio. In summary, the dramatic plunge in Applovin's stock price today serves as a powerful illustration of the tension between market expectations and the often unforeseen realities of the business world. The expectation was one of continued AI-fueled growth and market expansion. The reality is a stark reminder of the regulatory risks that are inherent in the ad tech industry. While the company's underlying technology and financial performance remain strong, the cloud of the SEC investigation will likely hang over the stock for the foreseeable future. The narrative has shifted from one of pure growth to one of growth tempered by significant regulatory risk. This is a critical juncture for the company and its investors. The outcome of the SEC probe will be a defining moment, and until there is more clarity on that front, volatility is likely to remain high. This is a story that is still unfolding, and for anyone invested in the tech sector, it's one that warrants close attention. The interplay between innovation, regulation, and investor sentiment is on full display here, and the final chapter for Applovin in this particular saga has yet to be written. This situation is a clear example of why it's crucial for those engaged in self-investing, whether through an individual brokerage account at Fidelity or a more modern platform like the Robinhood app or SoFi, to stay informed about the news and events that can impact their investments. The ease of online investing through various investing sites should not be mistaken for a lack of risk. If you found this helpful, don't forget to like and comment your thoughts. Let's discuss. Disclaimer: this is not financial advice. Please do your own research before making any investment decisions. Trading involves risk, and you could lose money.